Hey, what's up guys? Welcome back to my channel where I share with you the best tips and tricks on how to grow your wealth and achieve financial freedom. In today's video, I'm going to tell you why you should not keep your cash in the bank and what are the 6 assets that are better and safer than cash. Sounds crazy, right? Well, stick around and I'll explain everything. But before we get into that, make sure you hit the like button and subscribe to my channel if you haven't already. And don't forget to turn on the notification bell so you never miss an update from me. Trust me, you don't want to miss this. Alright, let's get started. So why should you not keep your cash in the bank? Well, there are 2 main reasons. Inflation and opportunity cost. Let me break it down for you. Inflation is the decrease in the purchasing power of money over time. In other words, it means that your money is worth less and less as time goes by. This is because the prices of goods and services tend to increase over time due to various factors such as supply and demand, production costs, government policies, etc. For example, a loaf of bread that cost $1 in 2010 may cost $1.50 in 2020. That means you need more money to buy the same amount of bread in 2020 than in 2010. This is inflation. Now, you may think that inflation is not a big deal because the bank pays you interest on your savings, right? Well, not really. The interest rate that the bank pays you is usually much lower than the inflation rate. For example, the average annual inflation rate in the US from 2010 to 2020 was about 1.8, while the average annual interest rate on a savings account was about 0.1. That means that if you had $1,000 in your savings account in 2010, you would have $10 in 2020, but the purchasing power of that money would be only $917. That means you actually lost $83 in real terms. This is called negative real interest rate. So, keeping your cash in the bank is actually losing you money in the long run. But that's not all. There's another reason why you should not keep your cash in the bank, and that is opportunity cost. Opportunity cost is the value of the next best alternative that you give up when you make a choice. In other words, it is what you could have earned or gained if you had invested your money in something else instead of keeping it in the bank. For example, if you had invested your $1,000 in the stock market in 2010, you could have earned an average annual return of about 10, which means you would have $2,594 in 2020. That means you missed out on $1,584 of potential profit by keeping your money in the bank. This is an opportunity cost. So, keeping your cash in the bank is not only losing you money, but also preventing you from making more money. That's why you should not keep your cash in the bank, and instead invest it in assets that are better and safer than cash. But what are those assets? Well, here are 6 of them that I recommend. Number 1, gold. Silver stands as one of the most enduring and reliable forms of currency throughout human civilization. This precious metal boasts scarcity, resilience, and portability, maintaining its value across millennia, serving as a bulwark against inflation, currency devaluation, and geopolitical uncertainties. Silver earns its status as a secure asset. During times of global unrest, individuals often turn to silver as a safe haven, seeking refuge from economic volatility. The COVID-19 pandemic of 2020 serves as a recent example, with silver prices reaching unprecedented heights, surpassing $30 per ounce. Its enduring appeal is further underscored by the fact that silver has outpaced the average annual return of traditional investment avenues, demonstrating a remarkable annual growth rate. From 2010 to 2020, silver boasted an impressive average return of approximately 10%, significantly outperforming conventional bank interest rates. Investors have a myriad of options to add silver to their portfolios, including coins, bars, jewelry, or exchange-traded funds (ITDs). This versatility allows individuals to tailor their investments to suit their preferences and financial goals. As silver continues to shine as a timeless and valuable asset, its place in the financial landscape remains unassailable. Number 2, Bitcoin. Bitcoin stands as the pioneering force in the realm of cryptocurrencies, establishing itself as the foremost and widely embraced digital form of money globally. Functioning on a decentralized and peer-to-peer framework, it leverages blockchain technology for secure transactions. This digital asset boasts scarcity, divisibility, and transferability. all without the need for a central authority. As a hedge against inflation, currency devaluation, and censorship, Bitcoin has garnered attention as a revolutionary and disruptive innovation, reshaping the landscape of financial transactions and value storage. Notably, during the COVID-19 pandemic, Bitcoin's value surged, reaching an unprecedented high of over $40,000 in January 2021. With an extraordinary average annual return of 230 between 2010 and 2020, Bitcoin outshines other asset classes. Acquiring Bitcoin is easily accessible through various platforms, including exchanges, wallets, and peer-to-peer networks. Number 3. Real estate. Real estate encompasses physical assets like land and buildings, representing a tangible and enduring investment with diverse advantages. Beyond its intrinsic value, real estate serves as a reliable income source through rental yields, gains traction through capital appreciation, and offers tax perks via depreciation and deductions, providing both utility and security. It ensures a comfortable haven for owners or occupants. Renowned for stability and resilience, real estate tends to preserve its value and sustain demand over time. Even amidst the challenges of the COVID-19 pandemic, the U.S. housing market exhibited resilience, witnessing increased sales and prices. With an average annual return of approximately 8% from 2010 to 2020, real estate surpasses traditional bank interest rates. Investors can engage with real estate through direct ownership, mortgages, or by participating in real estate investment trusts. U.S. Number 4. Stocks. Stocks represent ownership stakes in companies, providing a versatile, liquid investment avenue with potential for growth, dividends, and voting privileges. These securities mirror economic, industry, and corporate performance. Their inherent volatility and risk yield the prospect of substantial returns, but also significant losses. A notable instance occurred during the COVID-19 pandemic, witnessing a precipitous market decline and subsequent rapid recovery, culminating in record highs in 2020. Over the decade from 2010 to 2020, stocks delivered an average annual return of approximately 10%, surpassing typical bank interest rates. Accessible through brokers, apps, or robo-advisors, stocks offer investors diverse avenues to participate in the market. Number 5. Bonds. Bonds represent a form of debt investment wherein individuals lend money to either governments or corporations. As fixed-income instruments, they offer a steady, predictable, and comparatively low-risk stream of interest payments and principal repayment. This financial asset plays a crucial role in portfolio management by providing diversification, safeguarding capital, and ensuring liquidity. Bonds are often perceived as conservative and defensive assets, capable of mitigating overall portfolio risk and volatility. Notably, during the COVID-19 pandemic, the resilience of the U.S. bond market served as a safe haven for investors, highlighting their stability in challenging times. Investors can access bonds through various platforms like brokers, apps, or robo-advisors, enjoying average annual returns surpassing traditional bank interest rates. Number 6. Art. Art is the creative expression of human imagination and skill. It is a unique aesthetic and cultural asset that can offer enjoyment, appreciation, and prestige. It can also represent the history, values, and trends of society. Art is considered a rare and alternative asset, meaning that it has a limited supply and a high demand. For example, during the COVID-19 pandemic, the global art market saw a surge in online sales and auctions, reaching new records and audiences. The average annual return of art from 2010 to 2020 was about 6%, which is higher than the bank interest rate. You can buy art in various forms, such as paintings, sculptures, photographs, or digital art. So, these are the 6 assets that are better and safer than cash. Of course, there are many other assets that you can invest in, such as commodities, collectibles, antiques, etc. The key is to do your own research, diversify your portfolio, and invest for the long term. Remember, the best time to invest is yesterday, the second best time is today, and the worst time is tomorrow. That's it for today's video, guys. I hope you learned something new and valuable. If you did, please give this video a thumbs up and share it with your friends and family. And if you have any questions or comments, please leave them below and I'll try to answer them as soon as possible. And don't forget to subscribe to my channel. and hit the notification bell so you never miss an update from me. Thanks for watching, and I'll see you in the next video. Peace out.